Hey guys, welcome back to the channel. It's Willie again. Today I want to take a look at Public Storage. I felt like this stock would be an interesting one to look at. It's currently trading at, call it 366. Over the past 6 months, you're looking at up 14%. Yeah, I mean, it seems like a really good company, just kind of a thought process here. You know, people are going to be using storage buildings and all that stuff for a long time because everybody has a lot of stuff, it seems like. But yeah, let's take a look at the spreadsheet. Let's look at some numbers and see if we like it at the 366 number. So in our spreadsheet, stock ticker PSA, for anybody who's interested, 366 is the current stock price. So, revenue, net income, free cash flow growth, looking pretty good. Revenue 5%, net income 7%, free cash flow growth 4%. Shares are going up, but just like the company I looked at before this, it's growing at a rate that I'm not too concerned about. It's 0.25% a year. I'm not that concerned about it. Frankly put, especially when the pricing metrics are showing me that it's so overpriced. You know, I think companies should issue shares if their shares are overpriced, because if management thinks the company is overvalued and people are willing to pay a premium for the stock right now, and they're not going to want to pay a premium later on, say in the next recession or whatever, go ahead and grab up that money now. Issue those shares, grab that money, put it toward whatever you need to in the business. I mean, why not? Basically, you're basically selling to suckers and taking their money, but I mean, it's a business thing. If they're willing to pay that much at the fair market price, then, you know, issue the shares and sell the shares, because why not? Earnings and free cash flow per share, good, growing at, 6.5% and 4% respectively. Assets are here, they're growing, you know, neither here nor there on that one. I don't have a strong opinion with assets. Dividends growing, something I like to see. However, we have seen a plateau here recently in the dividend number. I wouldn't find that concerning, but I think it's, you know, it may have to do with management's perceived slowing down of growth in the future and their inability to pay a dividend, you know, an increased dividend every single year. But, you know, they're still issuing the dividend. They haven't cut it. They've just stabilized it, which is not that concerning. If they had cut it, I would definitely be somewhat concerned about that. Debt is something that I'm a bit concerned about, because over the past few years, you've seen a lot of growth in the debt number. That is a bit concerning that you have debt growing so quickly. You're looking at 18% a year over the past 10 years. That is a bit of a concern. Like right in here, you've seen pretty flat numbers. I don't know what has happened over the past few years. That may be acquisitions or something. I don't know. I would definitely check into the debt level to see if you're comfortable with that. Cash, really low. Not a lot of cash compared to other companies. Net debt is, you know, you're having the same problem with the total debt. You're seeing these big numbers come up here recently. Yeah, definitely do research, get comfortable with that. ROIC, really good numbers coming out of Public Storage. Good job, guys. On to our metrics. They're screaming overpriced. Debt compared to free cash flow is very low. So the problem I have with debt is not that it's high. The problem I have with debt is that it's been growing so quickly, much faster than free cash flow has been growing. So I don't want debt to grow at such a rate that it would become unwieldy compared to the free cash flow. So I'm concerned with the growth rate, not the amount of debt. 5-year revenue growth, good. 5-year earnings growth is negative 1%. Yeah, that's about right. It's been about flat since 2015. Okay. Free cash flow growth, positive 1%. Shares outstanding, low enough that I'm not concerned at all. 5-year ROIC, really good. Yeah. Forecast, free cash flow forecast, I'm growing at 5%. I'm growing net income also at 5%. I assign a 20 multiple for them. I think it's a company that has, well, I feel like if they're going to keep growing at this sort of rate, I think they do have a moat. It's not as strong as some other companies, but I'm going to be a bit aggressive here, I guess. I'm going to be a bit aggressive and give them the 20 multiple. So you're in at 366. You get our price targets, and you get a price target in 10 years of $258.90. You're in at 366. You get the cash flows. You're out at 258.90, and you get a 1% return. You're getting 1% a year. Whoopee. I mean, I don't really know what to say about this company. I expected a lot more. The only thing that I think may throw off this sort of analysis, the only thing I think could throw off this sort of analysis is the fact that it is ran as a real estate investment trust. It's a REIT. But I think it's less of a REIT than other REITs, because I wouldn't think that the real estate is a major part of their business. I would think the storage business is the big part of their business. But this is really something I figured out after I did the analysis of the company. And so I think this may be a concern with the analysis and saying you're only getting a 1% return. Now, I don't really know how you would go about analyzing a REIT other than this sort of format. I know banks and insurance companies and those more financial centric companies are not going to work with this sort of analysis because they're valued differently. Like a bank, you would be looking at price to book value rather than price to earnings multiple. So, I mean, I guess a REIT is just so different that this analysis is thrown off, or this analysis is just showing that you're overpriced. I think that's what it's showing. I think this analysis is going to continue to work because it's based on sound principles. I think you're just looking at a high price, high price, you get a low return. That's just the way it works in the stock market. Beyond that, I don't think the fact that it's a REIT is affecting it much. But I think Public Storage is a good company. I just think they're so overpriced. I think this is something you could throw on your watch list, but beyond that, I don't think you'd be interested in it whatsoever. Unless you do some digging in the 10K and reports and earnings calls and articles and whatever else, you can find something in there that says that the company is going to do better. But I don't, nope. Unless you analyze it a different way or something like that. I'm just out on this one. Throw it on a watch list, though. That's not a terrible idea. Wait for it to drop and then pick it up, because it's not a bad company. It's a good company. It's just overpriced. So, now that we are at the end of our analysis, I just want to say thank you guys for watching. Comment below any stocks you want me to take a look at, or any comments that you have. That's why it's called a comment section. Any comments that you have about how I could improve these videos. I want to do the best that I can and provide the most information that I can in the most useful way possible. If you want me to go over some concepts, some concepts in depth. If you're like, well, what the heck is free cash flow? Explain what free cash flow is. Then, I can sit down and do a video on what exactly free cash flow is. Or if you're wondering, why the heck do I care about outstanding shares? Nobody else talks about outstanding shares. Then I can do a video about why you should care about outstanding shares when you're investing in a company. Just comment what you guys think, what the thoughts are. I'll read the comments because, frankly put, I'm a small channel and I don't get many of them. So I like to read them and get input and all that good stuff. Like, comment, subscribe, all that YouTube stuff that I think the algorithm obligates me to tell you. But beyond that, I have reached the conclusion of this video, so I will stop here, and I will catch you guys in the next one.